Good morning, everyone. My name is Don Daniel, founder of P.I.L.L Method International. And P.I.L.L stands for prepayment of principal, isolating the principal amount, leverage, and liquidity. And we are live right now on Clubhouse, on YouTube, on Twitter, on LinkedIn, and Facebook. So I need to share with you. I just shared with you our link to our YouTube channel and what we're going to be watching on our YouTube on the screen. We're going to go over the numbers. Why should you avoid 15-year mortgages? Why should you avoid 20-year mortgages? I'm going to talk about why you should never get anything less than a 30-year mortgage. And if they offer 40-year mortgages, you need to jump on even the 40-year mortgages with both feet. And I mean quick, fast, and a hurry, because it offers you more options. More options. The longer the term, the more options you have, and it's easier to pay the loan off cheaper and faster with the longer terms. We're going to go over the numbers here, but I got to plug my computer in. Okay, hold on. I had to plug my computer in because I don't want to lose power. All right, here we go, folks. Let's get started. Oh, by the way, if you're in Clubhouse, come to the stage, raise your hand, come up to the stage, and you don't have to, you don't have to engage in the conversation. I would like it if you did. Okay. I would like it if you would talk to me. So come on in, let's talk. And if you just want to sit and learn from the stage, raise your hand, come up. Now, the reason why we ask you to do that is mainly because if you have a question, it's going to be easier for you to ask it. And if you have a comment, you can make that as well. The other thing is, when you come to the stage in Clubhouse, you invite other people just by your presence. So if you like what you're hearing, if you appreciate the information, all I ask is that you do a little something to give back. And the least you could do is come to the stage and invite some people in. So raise your hand, I'll bring you up, and then you can just sit there and learn. How about that? Okay. Anybody? Any takers? All right, come on up. All right. So let's go ahead and get started here. If you want to see what we're doing, make sure you go to YouTube. And when you get to YouTube, all right, let me see here. All right, let's bring her up. Invite as a speaker. All right. Thank you, everybody. Come on up. Thank you, everybody. I appreciate it. All right. Miss Wanda. All right. Invite King and Miss Cora. All right. Excellent. How are you all doing this morning? Anybody who can speak, go ahead and flash your mic. Open your mic up, and then we'll recognize you. All right. And if you can't speak, if you're like at work or driving or something and you don't want to speak, that's quite all right. But if you want to say hi, just flash your mic and we'll recognize you. All right. Great. All right. Listen, if you have a question, jump in at any time. You don't even have to wait for a break. You can interrupt me and ask your question. Okay. Because sometimes I got 4 screens to look at, and that's why I may not pay attention to everybody on the Clubhouse stage. Okay. So here's what we're going to do. I've got the link in there. All right. I've got the link in there so you can see what we're doing on YouTube. But when you get to YouTube, make sure you subscribe to our YouTube channel, subscribe and like the videos and comment. That is very important for the algorithm, so more people can see the content. Subscribe, like the videos, and comment. All right. Very, very important. So let's go ahead and jump in as to why it is important never to get a 15-year mortgage. If you want to see the numbers, we're going to put that on the screen right now. There we go. We're putting that on. I am going to put this on here. There we go. All right. So I got an amortization schedule on, and the median home price in the U.S. right now is $420,000. Interest rates are hovering right around 7.5%. Okay, 7.5. All right. And the payment on that would be $2,936.76. So I'm also going to do this. Okay. I'm going to put this in at a 20-year mortgage. That's a 25-year mortgage. That's 300 payments, 300 payments, same mortgage, same everything, except we're doing 300 payments there. That's 25 years. And then I'm going to do another one at 15 years. So we're going to duplicate this step. So we're going to have 3 mortgages ready to go, 420,000, one at 30, one at 20, the other one at 15, which is 180 payments. All right. And our different payment amounts. Now, here's why you don't want to have a 15-year mortgage. Basically, I'm going to also give you the link to Brett Whistle. All right, I'm going to give you the link to this so you can play around with it yourself. This is a teaching tool that I use. This is not my program. I just use this as a teaching tool. So we're going to copy that link. We're going to put it into the comment section here online so people can have it. And I'm going to give it to you guys in Clubhouse as well. There we go. And that's the link to this amortization calculator, which is going to be very useful to you in the future. All right. Here's the first reason. You don't need permission to have a 15-year mortgage. If you have a 30-year mortgage, the only difference between the 30-year mortgage and the 15-year mortgage is the paperwork, because the payment on a 15-year mortgage you can calculate yourself. If you have a 30-year mortgage, all you have to do is calculate what the 15-year payment is and then make it. You can make the 15-year payment. Now, I'll tell you a little secret without going into all the math. If you get a 15-year mortgage from the bank, all right, you have a 15-year mortgage from the bank and you make every single payment, you'll pay it off in 15 years. If you get a 30-year mortgage from the bank and make the 15-year payment, you'll actually save more interest and pay off just a little bit sooner doing it that way. Okay? Now, that's how the math shakes out on this thing. So let me show you what the payment is on the 30-year fixed. It's $2,936.70. Okay. If you have a 15-year mortgage, the payment is $3,895.45. So let me ask you, if you have the 30-year mortgage, is there any reason why you couldn't just make the 15-year payment if you wanted, if you could afford it, $3,893.45? You could do that on your own, couldn't you? Has anybody ever told you that you don't need permission? Listen, it kills me when people will refinance. They'll refinance to get a 15-year mortgage or refinance to get a 20 or a 25-year mortgage. You don't have to. You really don't have to. A refinance costs you money. A refinance costs money. Can I show you how much? If you want to see how much money a refinance would cost to refinance your 30-year loan into a 15-year loan, all right, into a 15-year mortgage, put a number 9 in the chat if you want to see how expensive it is. It is truly mind-boggling how expensive it is to refinance to a 15-year mortgage. Put a number 9 in the chat right now if you want to see how expensive it is. Cora wants to know. So Cora, here's what we're going to do. I'm going to use this 30-year mortgage first, okay? The 30-year mortgage, and we're going to say that most people refinance every 5 to 7 years. Every 5 to 7 years. So we're going to refinance this thing after, let's say after 7 years. Okay. Let me get rid of some of this advertising on my screen. All right. So we're going to scroll down. We're going to scroll down to 7 years into this thing. All right. That's 84 payments. And 84 payments on this mortgage, you only pay it down by $34,296. But in 7 years, you've already paid $212,000 in interest. Look at that. All you new people that are coming in right now, if please come to the stage if you'd like. Just raise your hand. I see Nicole, I see Jaman, I see Kiona, Ramel, and Crystal. Raise your hand, come to the stage, and learn from there. Plus, if you have a comment, go ahead and make your comments, okay? So Cora wants to see how expensive it is. Kiona wants to see how expensive it is, and Jaman. So if you're looking on your other phone or your iPad or your other computer, you are watching us on YouTube right now. And if you're watching us online, share the link right now to everybody that's following you on social media. Everybody needs to see this. So after 7 years, you've paid this mortgage down to $385,000. Okay, $385,000. So this is how much you owe now after 7 years. All right, so we're going to take that number and put it into a brand new amortization schedule. All right, so let's see here. We're going to open up a new one. No, we don't want that. We want to open up a new amortization schedule right here. And now we're going to put in how much we owe. We're going to paste that in there. Right now, we owe $385,000. Okay. And we had a 7.5% interest rate. So not only are we going to refinance this loan to 15 years, thinking it's better. What if the interest rates drop by 2 points? Oh man, let's make it even more exciting, Cora. How about that? So we're at 7.5 now. What if we can get this down to 5.5? Do you know how many people would jump on this with a heartbeat? We're going to get a 5.5. All right. And now we're going to change it to 180 payments. 180 payments. Now, don't forget, even though we paid it down to $385,000 from $420,000, the next thing we have to do is not forget about the closing costs. Don't forget about your closing costs. The closing costs on this, let's say the average closing cost on these loans, I've seen it between $8,000 and $17,000. Closing costs on a refi. So let's just call it $10,000 instead of $385,000. Let's make it $395,000. $395,000, and we now have a 15-year mortgage. All right, there we go at 5.5%. It's just a little bit more expensive than the old 30-year mortgage. Now our payment is $3,233.22. Our old payment was $2,936.70. $2,936.70. Our new payment, boom, let's move this over here. Our new payment is $32.33, just a little bit more. But now we have a 15-year mortgage. But now I want to show you something. Now, because we rolled in the fee, the closing cost of $10,000, don't we have to pay off the first $10,000 to get back to our original $385,000 we had before we refinanced, Cora? Do we have to do that? Yeah, we have to pay back that $10,000 first. Let me show you how expensive it is to pay back that $10,000 if you're not paying attention. We have a 15-year loan now. We've paid our mortgage down some. Interest rates have dropped by a full 2 points from 7.5 down to 5.5. And now we have a brand new mortgage. Let's see how long it takes us to pay off the first $10,000 with this new loan. Okay, so we've got 5.5, 180 payments, okay? And we're going to take a look at cumulative principal and cumulative interest. We have our new principal payment of $1,400. The interest is $1,800, which is still, I think, too much. But if you add up all the principal payments, it takes 7 months to pay back the first $10,000 that you rolled into this loan. I need you to take a look at how much interest you paid. We reduce it to 15 years. We have a new interest rate of 5.5, and we see now it cost $12,557.79 to pay back the first $10,000. So in essence, you borrowed an extra $10,000 from the bank, and they charged you $12,000 in interest to borrow that money. Let me put it to you this way. Let's say your credit union sends you a letter, an advertisement, and says, have we got a deal for you? We're going to lend you $10,000 for 7 months, and all it's going to cost you is $12,500 in interest for 7 months. Would you take that deal? Put a yes or a no in the chat. If your credit union says, we're going to lend you $10,000 for 7 months, you pay back the $10,000 plus $12,500 in interest. Would you take that deal? Okay, Wanda G says no. She's not going to take that deal. But do you know everybody who saw this as an opportunity to get a new 15-year mortgage and get that lower interest rate, roll that fee into the loan, and now the bank is making over 100% interest on this new loan? Wow. The other thing that is devastating is right here. Look at this principal payment. Look how much goes to principal here. $1,400. And I want you all to remember this. When you control the principal payment, you control the loan. Don't let the bank control the principal payment. You learn how to control the principal payment. Can I show you something here? Let's go back to our original 30-year loan at 7.5%. I'm going to show you that the principal payment, look at this, $300, $311 going to principal. If you're going to make every single payment here, that can be devastating to you. But if you want to accelerate the payoff so that you can save a ton of interest, I'm going to show you what happens when you prepay. Remember, the P.I.L.L method stands for prepayment of principal, isolating the principal amount, leverage, and liquidity. And today we're studying why we want to avoid 15-year terms and big down payments. Okay? So when I have a 30-year term, my principal payment is smaller. Now, it may be counterintuitive that why would I want a smaller principal payment, Don? It's going to take me longer to pay off the loan. Yes, that's true if you make every single payment of 360 payments to the bank. But what if you choose to give the bank back their money at a time of your choosing instead of theirs? You choose when to give money to the bank. So let me give you an example. Let's say I make my first payment here. I make my first payment in January, and my second payment is in February. All right. First payment and my second principal payment is in February of $313.65. But we don't have to wait till February to give the bank additional funds. If we have it, we can give the bank an extra $313.65 whenever we want. Let's just say we make our regular mortgage payment, and now we're going to give the bank $313 and put it on principal in the same month as we make our first payment. What happens? All $313.65 is subtracted from what we owe. we're paid down to line two in the very first month. So that makes our next mortgage payment on line 3. That becomes our new February payment. We just got rid of one line off our schedule for $313.65. This is gone. So 2 things you need to remember. Control the principal payment and you control the loan. And the interest payments you can skip don't matter. I don't care how big the interest payments are if I can skip them. And right now, by paying this $300 early, I skip an interest payment of $2,623.05 that I never have to give the bank. And how did I get rid of it? I got rid of it with this small principal payment. What happens when we lower the interest rate and we lower the term? Lowering the term and lowering the interest rate does this to the principal payment. Now, if I want to prepay this loan, I got to come up with $1,426 to get rid of one line. I make my regular mortgage payment, and now I got to pay a whole $1,400 to remove one payment from my mortgage. Do you realize the bankers know this? The people who own the bank know this, that when you lower the interest rate and you lower the term to 15 years, you make it harder to prepay this loan, to save money, and to get out of debt faster. Listen, my clients who have this loan, where they have $300 going to principal and $2,600 going to interest, can pay this off in about 7 years. So folks, if you can pay off this 30-year loan in about 7 years, what are we doing trying to reduce a mortgage down to 15 years and make it harder to pay? Not only that, oh Lord, have mercy. Not only that, but if you get a 15-year loan, 15-year mortgage, you're stuck at this higher payment. You're stuck there. If you get a 15-year mortgage, then you're saying, by contract, I got to pay this higher payment. Now, what if you didn't know anything about the P.I.L.L method? What if you didn't know anything about what we teach? Okay. And you decided, you've learned now that I can get a 30-year mortgage and make the 15-year payment if I want to. And you say, well, let me go ahead and make that 15-year payment while I can afford it. But what happens when things get tight and you are making that 15-year payment, even if you got used to making the 15-year payment? When things get tight financially, things happen all the time. When life starts lifing and and finances get tight, do you realize you can always drop back to the original 30-year payment? Yeah, you can do that. But if you have a 15-year mortgage, there is no going back. You have to refi that thing to get that payment lower. Listen, folks, it makes absolutely no sense at all. I can't think of one good reason at all to get anything less than a 30-year mortgage. Don't get a 25, don't get a 20, don't get a 15, don't get a 10. Get a 30 and pay it off in about 7. Does this make sense to you? Are you seeing these numbers? If this makes sense to you, what I'm talking about, put a number 7 in the chat. And those of you that are watching us online, put a number 7 in the comment section. Put a number 7 if it makes sense to you. All right? Put a number 7 in the chat if what we're talking about makes sense. And of the people on the stage right now, I got Wanda, I got King, I got Cora. Do you have any comments or questions about what we went over so far? Anybody? Nope. If you're in the audience on Clubhouse, raise your hand, come to the stage if you have a question or a comment about what we just went over. So if you're getting that, now I'm going to look here. So Jaman understands it. Task understands it. Okay. All right. If you don't understand it, put a number 5, and I'll go over this part again. If there's something you don't understand about this, put a number 5 in, and we'll go over it again. All right. And while you're doing that, while you're responding, I'm going to put my 10K card, my digital business card, all right, in ICE 10K. There we go, ice10k.com. And that link is above our heads there. All right. And you can click on that to contact us. Okay. I'll even give you our office phone number. I'll put that in the chat as well. Our office phone number is 269 back it up, 256 886 1867 is the office phone number if you ever want to call and ask some additional questions. Okay, here we go. Now, let's talk about this. I'm not seeing any 5s, so I guess everybody is understanding that part. Now, why do we teach never put a large down payment down? Now, this is going to take some math, and it's going to take a little bit of time, but I'm going to break this down slowly so that you can watch this over and over again. I've got a brand new mortgage here of $420,000. And what if we want to put 20% down so that we can avoid PMI? All right, so let's do the math. Okay, $420,000. $420,000. All right. Now, if I don't put 20% down, I've got to pay PMI on this. PMI is about 1.5% on average. Okay. 1.5% on average. So get your notes out, because we're going to need, let me get a pen here. Okay. Get your notes out, because we're going to go over this. All right. We got 420,000. Write it down. Okay. 420,000. Come on, pen. Work for me. I got to tighten this up on my pen here. Okay. 420,000. All right. And our PMI is like 1.5%. So if we do this times, okay, 1.5%, 1.5%, okay, equals, all right, wait a second. I did that wrong. Okay. $420,000, 420,000 times 1.5% equals $6,300. All right. And we're going to divide that by 12. Boop, 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 boop. There we go. All right. 525. All right. So now, if we pay, that's 525 a month for PMI. Okay. 525 a month for PMI. How many months do we have to pay that until we get the loan down to 80%? Okay. So we're going to take the 420,000. Okay. 420,000. Oops. Come on down. You can do this. 420,000. And then we're going to, let's see, what is 20% of this? Okay. Times 20% equals $84,000. So we got to pay the bank $84,000 so we can avoid PMI of 525 a month. Okay. So if we take that 420,000 and subtract 84,000, okay. All right, 420. Okay, clear that. 420,000 minus 84,000 equals $336,000. $336,000. So if we pay this down to 336,000, the PMI drops off. Okay. Now let's look on our amortization schedule and see how long that takes to get down to 336,000. All right. 336,000. If we make every single payment on time, I'm scrolling down, 336,000. And there we are. All right. 336,000 is right in here, about 158 payments. Okay. 158 payments. And that means now our PMI drops off, and that at this point we've paid $84,000 in PMI. Okay. Now, here's what I want to talk to you about. Instead of putting $84,000 down, which is 20%, why can't we put a different number down? And pay PMI, and then do something else with the rest of that $84,000. Let me show you what you could do instead. Instead of putting $84,000 down to get a mortgage of $336,000, put 3% down. Okay? Put 3% down. So now we're going to go back up to the top. Watch this now. 420,000. All right. And 420,000. And we're going to multiply that we're going to take 3% times 3. No, it's not 3%. It would be 3.5. 3.5 times 3.5% equals 14,700. 14,700. Okay. So we take our 420,000 and subtract 14,700. Okay. All right. 420,000 subtract 14,700. Oops. Delete. 700 equals, come on down. 420,000 minus 14,700. All right, that's 405,000. 405. Okay, but down we have to pay. That means we have to pay about $500 in PMI. Okay, now we've already put 14,000 of the money we have. We have $84,000 because we have the 20%. Let's say you have the 20%. You had all $84,000, but you chose to put down 3.5%, which is 14,700. And now you got to pay PMI. But you still have the remainder of the $84,000, don't you? Okay. So we got 84,000, and we've taken $14,700 of that money and placed it on the mortgage, only 3.5%. So we're going to subtract $14,700 equals $69,300. $69,300. We still have that in the bank, don't we? Okay. So let me show you what happens here. So we're going to take this loan. All right. We're going to take this loan and put in our mortgage, okay, of 420,000, but we're going to put 14,700 down. Okay, 420,000, and we're putting down 14,700 as a down payment, minus 14,700. Our new mortgage is $405,000. Okay, duplicate, tab. We're going to put in 405,000, 405. That's our new mortgage, 7.5, 360 months. All right. Calculate. This is our new payment. Uh-oh, I missed a zero. Sorry. 405,000. Our new payment is 3146.47. That's our new payment. Okay. And now we have PMI. But guess what? We still have $69,300 that we could. What can we do with that? Could we take our $69,300 and place that on principal if we wanted to? $69,300. Okay. Because we have to get this loan down to $336,000 to stop paying PMI. So we have, let's see here. 405,000. All right. We have 84,000. Subtract our 14,700. We got 69,000. So what if we prepaid $69,000 to this loan? Okay, we make our first payment and give the bank our $69,000 now. Let me show you what $69,000 prepaid to this loan instead of making a down payment of $84,000. Let's do with this because we already put $14,000 of it down. So let's put the rest, 69,300. So look at cumulative principal and just scroll down till you see $69,000 on here, 69,300. Okay, 69, there we go. It's going to be right around in here. Okay, here's 69,700. Okay, 69,700. Okay, we've already put 14,000 down. But if we put this down, 69,300, that brings us down by 20%. And it knocks off 134 payments and saves us $351,000. Ladies and gentlemen, does it make sense to put $20,000, 20% down, all $84,000 as a down payment? Okay, $84,000 as a down payment, when we could start here. Uh-oh, I put the wrong number in. Why'd you guys let me do that? It was supposed to be $405,000. 405,000. Okay. Sorry about that. 405,000. And now we put down our $69,300. $69,300. There we go. Come on, $69,300, right around in here. That's 144 payments. Okay. Isn't that 12 years? Did we just knock 12 years off this loan? And it brings us down to approximately $336,000 where we need to be. If we had made a down payment of $84,000, we would start out $336,000 on payment number one. If we make a down payment of $84,000, but if we take 3.5% of it and make a down payment, and then take our $69,000 left over and make a prepayment with it, we're paid down to the same place, but we've knocked off about 12 years off this loan instead. Ladies and gentlemen, does it make sense? Does it make sense to put a large down payment on a loan when we can take that money and make prepayments with it, knock 12 years off this loan, and save ourselves $337,000 in interest with that same money? King says, Lord have mercy. Come on. Wanda G. Come on, Wanda. Listen, thank you for the comments, everybody. This is why we're here. This is why I do what I do. So you can learn the truth about lending and what they're doing to us and how much we don't know about how this whole thing works. Everybody is trying to avoid PMI. But see, so what is it? What is it? If I put the 84,000 down, I avoid PMI. And Saeed wants to know what happened to the PMI. Well, Saeed, as soon as you get down to 80%, the PMI drops off. So what if you did this? You put 3.5% down, 3.5% down. This is your new mortgage, 405,000. Then you take the rest of the money, 69,300, and prepay it to your loan when you make your first payment. You're paid all the way down to $69,300. Okay, I hear you getting ready to come in. Hold on for just a second. $69,300. All right, boom, right around here. All right, in the first month. So what happens? Your PMI, you can apply to have your PMI taken off, and you'll make one payment of one, maybe two payments of PMI, and then it's gone. And so which is better? Putting $84,000 down and avoid PMI altogether, or take most of that money and make a prepayment and save yourself $300,000 instead of the what is it, 84,000 they wanted to charge you in PMI money altogether. So who Miss Wanda, do you have a comment? Miss Wanda, do you have a comment or a question? Because your mic, you're muted. Hello.
Oops, sorry.
Okay. All right. Go ahead and mute your mic. All right. All right. Somebody wants to come up and speak. All right.
Grand Rising.
Good morning, Steve. How are you doing, sir?
Oh yeah, I'm enthusiastic, and then you're giving me more strategy.
Did
So
you
win-win.
Did you hear all that? Did you hear all that?
Yes, sir. Yeah, I came in on it. But now, how are you asking for those types of terms? Because usually they don't want to give you that. And then I remember you had told me about a strategy before, but they would not let me do it.
What are you talking about? What won't they let you do? What strategy are you talking about?
Using the FHA. So I'm currently in the FHA.
Right.
So I was trying to switch that one to a conventional and then reuse the FHA. But they kept saying that my credit score wasn't good enough. They wouldn't let me do it.
Well, here's the thing.
It was a higher interest rate.
Here's the thing on an FHA loan. FHA, as far as I understand it, the PMI never drops off. So I'm talking about a conventional mortgage where you can put 3.5. You could put 20% down, and I chose 3.5. I should have chose 10. I should have did this at 10. You want to put 10% down, and then put the other 70% on the loan. That's the numbers I should have used. 10%, and the rest of that money going to principal. But the strategy still applies. Never put a large payment down. Put the least amount down that will allow you to get into the loan. Put the rest on principal, and it still adds up to 80%. So I can put 10% down, and then the other 70% as a prepayment, which knocks a lot off my loan. Or I can put all 20% down. Okay, so I don't want to do that. I want to put some of my money down up front, and then the rest as a principal prepayment. So, Steve, does that help?
Yes, sir. Now, when you said 10%, you're dictating that, or the mortgage people dictate that?
Okay, so the mortgage people are dictating on a conventional loan at least 10% down. Okay, but the experts are saying you probably go ahead and put 20% down so you can avoid PMI. You see what I'm saying?
Yes, sir. So right now, if I seen the house right now,
Right.
because it was up the street, they told me I couldn't use another FHA, and they wouldn't let me switch out. So then I say I want to do what you just said, a conventional.
Right.
So then I tell them I'm putting 10% down, which is 30,000 on
Right.
300,
Mm-hmm.
and then whatever I want to put on the prepayment, I could do, and that's it.
There you go.
Wow. I
Okay.
know it's that easy, Don.
Yeah,
The
man.
Don way, the Don way.
Any other questions?
No, sir. Attitude of gratitude, man. I'm just so glad I ended up listening to you months ago. I've been
Okay.
following you ever since.
All right. Thank you. Miss Derica, how are you doing?
Hi, good morning.
Good morning. Good morning. What brings you to the stage?
I work as a registered nurse and I'm interested in purchasing an investment property. And I don't have $100,000 as a 20% down payment.
Okay.
Because most of the properties I'm looking at are between 4 and 600,000 because I want a 3-unit. And how the mortgage is structured that I'm seeing is the FHA is a better fit because it requires the smaller down payment. But I cannot apply the P.I.L.L method to that because I mean it requires a down payment. You can't get, I don't know any mortgages that you can get without a down payment.
Well, yeah, you're right. So what we're saying is you want to put the least amount down that you have to get into the mortgage and save
I
the
see.
rest of your money. Okay. But some people are in a position to put more down than they actually have to. So they do because they believe that's the best thing to do with their money because they will pay less interest over time and it knocks the mortgage down. But why do that when I can put the least amount down here and then take the rest of my money and prepay it? Does that make sense?
Oh yeah, that method makes absolute sense if you have that money on hand.
Right.
I'm just wondering how can I work this particular type of mortgage into my favor
Okay.
with this because I see a property for 445,000.
Mm-hmm.
The down payment would be 14K.
Okay. All right. So now are you using a DSCR loan, debt service coverage ratio loan, or are you going to a regular bank?
I plan on going to a regular bank.
Okay.
I haven't applied for the mortgage yet. I just
Right.
looked at the requirements and I know that my credit is in alignment and so is my income.
Okay, good. All right. So now you're looking at purchasing an income property and it's multiple
Yes.
units?
Yes, it's a 2-unit building. I would prefer a 3, but
Okay.
yes.
Are you planning on living there?
Yes.
Oh, well then you can get a conventional loan.
Really?
Oh yeah.
How?
Well, you can get a conventional. You don't have to get because you're living there. Anything up to 4 units is considered residential.
Okay, but how am I able to get a conventional loan without putting 20% down?
Okay, well you don't have to put 20% down. You can get 10. You can put 10% down.
Oh, so that would be 40. Okay.
Right now, if you were getting a loan for a strictly residential income property, now you're talking about 20% because now you're not living there.
I see.
You see the difference?
Okay. Mm-hmm.
Okay.
Mhm.
So yeah, you can put down 10% instead of putting 20% on a conventional. Yes, ma'am.
And they do have down payment assistance programs for nurses
Mm-hmm.
as well.
Okay.
But to me, getting down payment assistance is just another separate debt at that point. It's just 2 debts for one,
You got that right. You see, down payment assistance ain't free.
Exactly. Right.
It ain't free. Okay. So be careful of those things because they may come back to bite you in the end. All right. So yeah, tell us about that mortgage of yours that you're thinking about. And let's see how we might be able to structure this thing in a way that might help you based on what we're talking about today. And today we're talking about no big down payments if you can avoid it. And please don't get anything less than a 30-year mortgage. So do you want to tell us a little bit about it?
Oh, what I saw was this 3.5% down for FHA. You do have to live in the property to
Oh, look
get
at
it.
you. Look at you. Okay.
Um,
Okay.
and you can, from what I saw,
Mm-hmm.
you can, the PMI insurance is a necessity.
Right. And you will pay
And
PMI on an FHA.
right.
It doesn't drop off, even if you pay it down by
Then
80%.
and then what I also noticed was essentially like if I wanted to do a rehab loan,
Yeah.
it, to me, it doesn't translate well because I'm not distributing the money to the contractor. It's going from the bank to the contractor.
Right.
And so that's all I know so far.
All right. Well, let's see. I can't think of the name of that loan. Okay. Let me see
I
here.
think it's a 20 something. I forget.
20 something K loan. All right.
Yeah.
Something K loan. And then it's all in one. You can rehab the property and then mortgage all in one. I've heard that's a pretty good loan. Now,
Okay.
let me ask
I'll
you.
read further into it. It's just my friend, she went through it and she had a bad experience with her contractor. And I was like, I don't want to deal with that. I would prefer to just, you're paid by me and you're not doing things that you should be doing that you're being paid for.
Mm-hmm. Well, I tell you what, trying to find a contractor on your own is tough. You and you want to do a lot of research, talk to a lot of people, and find out how you can get a good contractor with a good reputation to help you with your
I know
with
one.
any
My best friend's
repairs.
husband owns a construction company and she's a broker.
Well, look at you.
So if I were going to do any work, it would definitely be through him because I trust him.
There
But,
you go.
oh, okay. Okay. I'll look into the 20 that loan and see which one is best.
Right. Now, I would also do some research on the very best thing to do on how to manage that money. Okay. Managing the money is up to you. How you pay, you have some, you have some discretion there. Okay. So here's what you don't do because it's a friend, because it's you trust them. You still want to do good business. Okay. When you complete work, then you get paid. Complete work, I pay you. Friend or no friend. Does that make sense?
Yeah, absolutely.
Okay. When you complete this stage of the job, you get paid. Okay. Please don't ask me for money up front. It ain't going to happen. Okay. Because if they're a good contractor, all right, they have a line of credit at wherever they're getting their materials from. And they can get their materials, and then when they tell you, listen, I need X amount down so I can buy materials. Nope. If you don't have an account, I'll buy my own doggone materials and have them shipped in. Okay. You just show up, do the work, complete the work, and you get paid. Period. Do not fall for that ever. I don't care who you are. Listen, even if it's your cousin or your brother, even if it's your dad, don't give them upfront money. What do you think?
Okay. I agree with that. I think that makes me feel safer.
Okay. There you go. Because
Thank you.
listen, once people get paid, it's hard to get them to show up sometimes. I'm just saying. All right. Anything else, Miss Derica?
No, thank you so much. You answered all my questions.
You're welcome. You're welcome. You're welcome. So everybody, listen, you've heard it today. So we want to avoid big down payments. We want to avoid 15-year loans. I can't think of a reason at all where I want to put a large down payment down when I can avoid it. I never want to get less than a 30-year. And please, 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 if they should ever bring back 40-year loans so that everybody can have a 40-year loan, you want to jump on a 40-year mortgage with both feet. Right now, as far as I understand it, the only way you can get a 40-year mortgage is to have is to, you know, get into trouble with your loans, and then, all right, somebody wants to come up as a speaker, all right, and then get your loan modified. You get your loan modified, you can get a 40-year mortgage that way. So that's what I know. Miss Tass, talk to us.
Hello, good morning, Don.
Good morning. Good morning.
I had a question. So, what do you like? Would you still recommend paying off the loan early if you have like low interest rate, or would you kind of recommend putting it somewhere else?
That is a good question. So here's what we need to understand. How much interest is that low interest rate costing me? Give me an idea of a mortgage with a low interest rate and we'll look at it. How much is the mortgage? What is the interest rate?
Okay, so are you asking me specifically?
Oh, yeah, I'm just telling you, what's your idea of a good mortgage? What's your idea of a low interest rate? And I'll put it in. We'll take a look at it. Because, see, to answer your question, here's what's happening. People say they'll say, okay, I got a low interest rate. What should I do? And they think they've asked a good question. But anybody who answers that question without knowing what the terms are, listen, you need to run from them as fast as you possibly can. Because what they should have asked you was how much was the mortgage, how much is the interest rate, so we can figure the interest cost on the loan, not just look at the interest rate. Does that make sense, Taz?
Yes, it does.
How much does it cost me? So give me something to work with, and we'll look at the difference between interest rate and interest cost. So give me a loan. How much?
Sure. So, we can do my personal loan, 260.
260. Okay. All right. So we're and that's where it started at 260,000.
Yes.
Okay. So we're going to put in 260,000. And listen, we're on YouTube, so it sounds like you're driving. So when you get a chance, you fast forward this to about 59 minutes into YouTube, and this is where you come on. Okay.
Okay, I will.
All right. So we've got 200. Did you say 260,000?
Yes.
What's the interest rate?
3.3.
3.3, which is way less than 7.5. So people look at that and says, oh, that's a cheap interest rate. But at 3.3 on $260,000, here's how much interest the bank wants. $924.80 over 30 years. $149,924 versus the $260,000 that you borrowed. That number equates to 57% of what you borrowed. So, does low interest rate mean low interest cost? Nope. That's a high interest cost. So now let's take a look at what's going on monthly here. Okay. So as you're paying on that mortgage, your very first mortgage payment, $423.68 goes to principal. And the bank says, yeah, you just give us $715 interest and we'll let you pay down your mortgage by $423 out of all the money you just gave us. $423 of your money goes to pay down the loan. You just gave us $715 worth of interest. In the first year, you pay this loan down by $5,161. Only $5,161 of all the money you gave them goes to pay down your loan in the first year. Guess how much interest they just charged you? $8,500. $8,502. So is $8,000 too much money to pay your loan down by $5,000? Tess?
Yes.
There you go. No?
Well, okay, well, I got a question.
Go ahead.
If you're saying that, I'm trying to follow you and try, but if you're saying so it's cost me $8,000 to pay it down to save $500 a month?
No, you got to give them to pay down your loan by $5,000 in the first year. Okay. You have to give them an additional $8,500 to do that in interest. Okay. A total of what, almost $14,000. So $14,000 is going towards the mortgage, but out of that money, only $5,000 goes to pay down your loan. Do you think that's too much money?
I think any money is too much money.
There you go.
I hear you now.
There you go. Okay. So when we hear low interest rate, does not mean low interest cost. So in the first 5 years of this loan, that's 60 payments. You only pay the loan down. You pay this loan down by $33,000, but the bank is going to charge you $48,000 in interest to do that. Okay. That's $80,000 paid out in the first 5 years, but only $33,000 goes to you. And that's at your interest rate. So does it make sense to prepay and save interest now, Taz, even on your loan? If you're talking, you're muted. Go ahead. You're muted again.
I was like, yeah, it does. It makes sense.
Okay, so let me give you an example. Just by prepaying $400 on your loan saves you over $700 in interest. That's pretty good. That's pretty good. So you don't need a whole lot of money to save a ton of interest on your loans, ladies and gentlemen. So let's be careful. If you want to know the month, day, and year you could be debt free, then go to my link up above, ice10k.com. ice10k.com. I'm going to put it on the screen here for you. If you're on YouTube, ice10k.com. And if you scroll down just a little bit under the picture here for Eric Thomas, the hip hop preacher, Dr. E.T., okay? Scroll down, you'll see a button that says Get Your Savings and Earnings Report. Okay? It starts out, when you click that button, it'll say, don't waste another dollar paying off the wrong debt. Get your free savings report. You can know the month, day, and year you could be debt free and how much interest you can save, and we'll give it to you for free. Okay. If you want to work with us so we can implement this plan, then we can talk about some of that interest savings, how we can get your bank to pay your fee so you can have a lifetime program with us. Okay. Of all that interest that you're saving, our average client saves about $100,000 to $150,000 in interest on average. Some save a lot more. So if you can save that kind of interest and a small percentage of that money pays for your program, then you're not out of any money. Who's out of money here? The bank is out of all that money, and let's use some of that money to pay for your program. All right. So go ahead and do that. Now, if some of you just want to try to do this on your own, I've got 2 years worth of videos on YouTube. Just go to P.I.L.L Method, watch the videos, and you can kind of come up with your own deal. But yeah, you're going to spend about $50,000 to $70,000 more in interest than you need to. Even if you get out of debt faster and cheaper, still you're going to pay more interest than you need to. So let's be careful. Whatever you do, you want to make sure you're paying the least amount of interest that's mathematically possible for you. And if you want to do that, click on the link above, go to ice10k.com, click on that link, and get a savings and earnings report today. Go listen, apply for it. It costs you nothing. It may take you a total of 10, 15 minutes to fill that thing out. But don't just put in the mortgage. Did you know the average family has 13 different debts? Put in everything. We don't just help people pay off their mortgage in about 7 years. We help them to pay off everything. Mortgages, your student loan, your credit cards, your car loan, put everything in, and we'll show you the best way to pay it all off in about 7 to 9 years on average. Some take a little bit more time, some a little bit less. It all depends on how much money you're actually making and spending each month. We're going to help you to come up with a program just for you. Okay? And does anybody have any questions about how to get a savings and earnings report now? Or any reason why they would want to? Good morning, Miss Sharon Jones. I see you in there saying good morning to me. All right. She's watching us here on YouTube. All right. Good morning to you. All right. And let me check and see if there are any other questions here. You have to refinance FHA. All right. Taz says you have to refinance on an FHA for the PMI to go away. You are so right. You are so right. Now, that's another thing we want to do. Let's not get so focused on one thing that we lose opportunities on others. So if I refinance, what's going to be the cost of the refinance? What is a long term? And how much PMI am I going to save? And what am I going to do with the money that I'm no longer spending on PMI? You see, it only makes sense to save PMI if you're going to use that money to prepay your loan so you can save interest, because you're already paying it. Even if you drop PMI, pretend that you still pay it and use the money to kill a ton of interest. Oh my goodness. We can certainly help you there. All right. Get a savings and earnings report. So here's the next thing you want to take a look at, ladies and gentlemen. Here's the next thing you want to take a look at is go back to the card and look at the bottom of the card. And it says here, become an affiliate. Right now, we pay affiliates between $300 and $3,000 a month to share the P.I.L.L method message with other people. And all you have to do is point them to our YouTube channel. Find somebody who is tired of paying their bills. Like, listen, like Taz. Okay, Taz, why you move yourself to the audience? You could have stayed up. Come on now. All right. So she says, any money is too much money. I love that. So if you're tired of paying all that money, if you know other people who are tired of paying all that money, here's what I want you to do. Share the P.I.L.L method with others. All right. Share the P.I.L.L method with others. Send them over to the YouTube channel. Call them in a couple of days, no more than 48 hours, and ask them if they want more information. Okay. And that's all you do. There's no selling here. So click on the affiliate button on my card. It takes about 15 seconds to fill out. Look here, put in your name, your phone number, your email, and just tell us how you want to get paid. Cash App, Zelle, Venmo, PayPal, and then click submit. Boom, that's it. You're done. You are now an affiliate. You will not, I repeat, you will not get an instant reply when you fill that out, but you will get an email in about 1 week giving you some instruction. Okay, there you go. How to become a P.I.L.L method affiliate, make between $300 and $3,000 a month just by sharing the YouTube channel. How does that work? Once you share the YouTube channel with someone, all right, call them in a couple of days, ask them if they want more information. All right, go back to the ice10k.com digital business card, scroll down underneath my picture, boom, 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 underneath my picture, and you'll see refer a friend. Click on refer a friend, and thou put in their information, their full name, their phone number, their email, their zip code. Put in your name and number, because we need to know who to give the money to. All right. Put in your name and number, and put in any additional notes about this person that you may think is relevant. That may help us. Then you click submit. Then our team will go to work, call up that person, and help them to save hundreds, tens of thousands, even hundreds of thousands of dollars in interest, pay off all of their debt in about 7 years. And when they become a client, we'll pay you $300 for that, for sharing the YouTube channel with somebody. Send us a second one in the same month. We'll pay you $400 for that one. A third one in the same month, we'll pay you $500 for that one. A fourth one in the same month, we'll pay you $600. And if you send us a fifth one in the same month, the fifth one is worth $1,200, and you add all of that up, it's $3,000. Okay. Pretty good Christmas money. There you go. So the other thing, the last thing here I want to talk to you about is my book. The only book on Amazon that talks about this subject, how to understand an amortization schedule and the tools you need to eliminate the maximum amount of interest that's mathematically possible. We share with you the reasons behind the our opportunity calculator. Our opportunity cost calculator takes a look at all of your finances and says, this is the thing you need to do in this month, on this day of the month. Here's how much interest you could save. It guides you like financial GPS. Okay. It is the only cloud-based AI computing system that makes sure you pay the least amount of interest that's mathematically possible. Cut out all of that interest and you get out of debt faster, because more of your money goes where you want it to go, not where the bank wants to send it to you. Okay? So, ladies and gentlemen, thank you so very much for being here today. Do I have any other questions or comments? Okay? Do I have any other questions or comments? Because we're getting ready to get out of here. Okay? Oh, and next Sunday, this Sunday we'll be on, but next Sunday we will not. Okay? It's getting close to Christmas. We got, we're going out of town. Our family's going out of town, but there will be replays on YouTube. All right. We're going to have replays on YouTube, Facebook, Twitter, and LinkedIn. So we're going to put some oldies but goodies up for the holidays while we take some time off and to, enjoy the fam. Okay. So anybody else got any questions or comments before we get out of here today? Any raised hands? Come on up. All right. You're going to listen. We're going to get ready to leave. Don't miss your opportunity. Get your question in there. Let me check the chat. I'm not seeing any new questions. Okay. So Saeed wanted to know what happened to the PMI. We answered that. All right. Well, good enough. Well, listen, thank you very much, folks. We're going to be back here on Sunday. Oh, next Thursday. Okay. Let me not forget this. Next Thursday. Let me put this in on the screen here. Next Thursday will be our last meeting with Living Manna Online Church. Living Manna Online Church. We did 8 weeks with them, and I'm putting that on the screen right now. All right. So Living Manna Online Church next week will be the 8th session. The 8th session of in an 8-week series. Okay. And what time on Sunday? Steve Mack says. Okay, Steve, it's 9:30 a.m. Eastern time on Sundays, 9:30 a.m. Eastern time on Sundays, where we are on Clubhouse, Facebook, YouTube, Twitter, and LinkedIn. Okay. And so 9:30 on Sundays if you want to be here live, or you can catch the replay. All right. But next Thursday will be our final session of Money Answers All Things, Bridging Faith and Finance Through Stewardship with Living Manna Online Church. And they have another ministry called Power of the Lamb. Okay. And you'll be able to watch that on their channels. And we're going to also broadcast it on the P.I.L.L Method channel as well. All right. So we're using their system, and we're doing the 8th session there next Thursday. And that's going to be it. Thank you, everybody. So don't forget, get the book. All right. Get the book. Here's what the book looks like. We're going to put that on the screen. All right. Oh, you know what? I should have had this crawling under the screen the whole time, and I didn't do it. All right. So we're going to take that off, put me back on the screen. There we go. Put me back on. There we are. Okay. And add this. All right. There we go. So we've got that going on. We're going to also put on the screen my book. That's what my book looks like. All right. Get the book on Amazon and start learning about this process. The very thing that the banks have been doing to us since 1936. This is the only book on Amazon out of 33 million titles that helps you to understand how interest from the banks actually works and how we can eliminate it. It also gives you a list of the tools you're going to need to beat the bank at their own game. All right. If you want to beat the bank at their own game, understand how the tools work. All right. There we go. All right. That's it for this week, folks. All right. Happy Preparation Day to you. And for everyone here that applies to, happy Sabbath tomorrow. I'll be at church. So listen, that's good news for us. And happy Sabbath to you. And I'm out of here. But before we leave, we want to hear from Dr. Eric Thomas. All right. And what he has to say about the P.I.L.L method and how it made his wife feel a whole lot better. Okay. E.T., what have you got to say to us this morning?
Listen to me, y'all. But one of his mentees took us through one of their programs, and I paid off my mortgage. But guess what happened? My marriage went to a whole nother level. And you know why? Because my wife is a security freak. And even when I blew up, my wife would be like, oh, you blew up, but how long is you gonna keep making this kind of money? I was like, I don't know, forever. She's like, you sure? Because I'm gonna keep my license as a nurse just in case you don't. So when I paid the house off, my boy was like, you ain't gotta do that, you can do this. But when I paid the house off using that program, it took the stress level all the way down for my wife because we no longer had a mortgage. Does that make sense? That thing that was coming every month, that was getting on her nerves, we didn't have that no more. And so she was at rest.